As I said, happy Thursday. Welcome back, all these familiar faces. And today's topic is seasonality and timing, specifically, obviously in the markets, but a lot of the technology comes from other fields, which is an interesting point to hit. I will start with the disclaimer. Not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this oops. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. This conversation will be recorded and posted for future reference. So as always, it's a open floor. Raise your hand if you want to come up. I actually have quite a bit of topics to cover on this because I find it quite interesting. It really affects every asset and quite a lot of physical phenomena, from like the weather to ocean tides and things like that. And I find that intersection of finance and science quite interesting. So, in the basic premise, seasonality is any kind of underlying cycle that's occurring in what we're going to be talking about is time series. And you can use it in two ways. The first way is you can take advantage of it. If you can identify and see that there is an underlying cycle occurring, then you will be able to take advantage of that by structuring your portfolio in such a way or developing a strategy or howsoever. An example of that, I would say, that's quite well known is the equities open to close U shape of volumes and things like that. Equities actually has quite a bit of white papers and published papers in this area. Other areas, commodities are second most covered, and then you kind of have everything else. If you were to put it into the commodity space, naturally agricultural commodities have seasoned by nature itself. Again, bridging that gap between finance and our physical world. When we look to kind of say take advantage of either the open to close, or you can say the overnight market in equities, there's different types of modeling that you can use to do that. But an often overlooked area of seasonality is the removing of seasonality. It's actually really important to understand that the seasonality can be considered a noise in your research, because it's this oscillation that hopefully is regular, but may not be so regular. Again, I will take like planet temperatures. We know that there are seasons in the northern hemisphere, but due to some changes like climate change, we might start to see alterations of those cycles, but they are going to be happening at a very slow time frame. Maybe not slow enough to save our planet, but that's a different point. And so there's actually quite a lot of different methods, and I'm probably going to do a big info dump here. Let me know if you have any questions on these aspects, whether it's the taking advantage of or the removal. But a couple that come to mind are Holt-Winter, which is a type of decomposition. You're able to extract different times of cycles occurring in the underlying time series. So you could think like short, medium, long, and you get some residual. Fast Fourier transforms are really helpful in this area as well. A very simple way to remove seasonality that we're all familiar with is first difference. So that's t0 minus t minus 1 or something like that. You see this in returns. So why people like to model against returns is necessarily because they have removed some of this underlying seasonality or differencing in price, and that actually helps you do other things with it. whether that's modeling a cash flow or modeling a new system, because you have removed some of this quote noise in it, and you have made this distribution a bit more stationary, you're able to get a lot better properties from it. And this is something that we actually take for granted, but there's a reason why this happens. And this type of transformation of making a distribution much easier to get a handle on um, is really kind of where I'm driving at. So this is something we have all done. We all are familiar with returns and how they have this log normal distribution, and that normality part of the log normal is something that we can exploit, as in, because it's log normal quote, and we've done this first differencing type of seasonality adjustment, we are able to better understand that and where it would deviate. So like the creation of VAR or expected shortfall. Another one is that going on this kind of side of returns, you have multiplicative and additive cycles. This again goes back into our discussions of ergodicity. Ergodicity, um, I won't go into it because it's a very complex topic, but we have talked about it in this clubhouse before. Multiplicative ergodicity is much stronger effect than additive. So if you could identify that a seasonality aspect or some time series trait is multiplicative instead of additive, that's actually a huge advantage, or like it gives you a lot more information. And then you can know that the relative strength of that versus an additive seasonality is lower. So why do we do all these things, right? I think I've kind of hinted it a bit. You can create weekly stationary series. I will say weekly because, again, things can change. The cycle can change, and it could break down that relationship. But you are able to kind of decompose that and measure that, so you could identify when things need to be changed. Another one is increasing the signal to noise ratio. Again, the returns really hammers home how simple it is to do something like that, and give yourself a better distribution to work with, something that has better characteristics. So going from percentage returns to log returns, and moving into even the log return space versus the percentage return space is even better, because then the things become additive instead of multiplicative. So you can see how in these very standard types of techniques we're using on an everyday basis, this thing comes through. And again, using it for more information. Even if you are not able to identify a quote tradable signal, you will very much understand a lot more about what you're trading. If you're able to decompose the, say, seasons of an agricultural versus the supply demand dynamic, one will be a much longer time frame than the other. That gives you a lot more information what's driving, we'll just say, the current trend. You might not be able to do anything about it, but it will give you kind of a radar to kind of identify potentially when the environment might change, or you might not do anything with that. It gives you a great story to tell your clients, but also how certain things interact. One cycle that I will discuss now is probably less well known, but it's the FOMC cycle effect. And it's the interaction between people's expectations of the equities market and the FOMC meeting. So we know the FOMC meeting is a discrete event. It's going to happen at a scheduled time, and we're going to know what's their result, right? Obviously, now they give us a lot of forward guidance and things like that, but the idea is that there's an increasing amount of uncertainty going into the meeting, and then after they've set the policy, there is some lag time whereby the market needs to adjust balances to the new Fed policy rate. This idea, not only are you able to do something about it, but it's taking something from a completely external source. It creates a cycle in the market. It allows you to position yourself for that, or at least be ready for that. And you can look at the different weeks after FOMC cycle. So like you look at the week of the FOMC cycle, the week, the second week, the third week, fourth week. Usually revisions come every other week. So on the even weeks, you get normally more information. So then you're able to say, okay, we can see how people are reacting to something ahead of time necessarily, because it's all should all be released at the same time to everybody, and how it will go over a longer period of time. So you are able to find out an information that is linked to the real world that might not necessarily be as evident in your just straight up research. So as always, raise your hand if you would like to come to the stage. I will leave it here and open the floor. Okay, since no one wants to make a comment, what I can see the real benefits of this. Again, I kind of laid that out, but I can dive a bit deeper into some of these phenomena. The agricultural commodities I find to be quite interesting because, again, like these seasonality, any seasonality that's controlled by some kind of external framework or external exogenous effect, I find to be more interesting, which is why I mentioned the FOMC, which would be the equities equivalent of a kind of seasonality versus the seasonality of, say, agricultural commodities. You get a tighter binding between the asset seasonality and its stationarity versus something that would, say, be purely in the financial market. And the example I will give of that is again the overnight equities premium, or the large volumes that are being pumped into the markets that creates the U-shaped volumes. And again, I'm really focusing on the U.S. markets because there's the most amount of literature there. Between the open and the close, because that's where or where most large institutions are beginning to work their book, and they probably have an axe to grind depending on what's going on. So the idea that there's these two different effects, one that's coming from that's endogenous and exogenous, is a very interesting point to me. And the more that you can kind of bring these things back to some kind of effect, I think is quite interesting. There's no reason now with global markets that necessarily this open and close, US open, US close premium exists. And we have seen that it actually has quite degraded over time. It used to be quite strong because, in my opinion, there was a risk premium to be held there because you were taking overnight risk. If you were in a short-term prop shop, they would want you to close your book by the end of the day. And the reason is because of lack of liquidity. But now with global futures, trading basically 23 hours a day on Globex, you've got the tight binding of the passing of the baton of volatility across Asia to Europe to back to the US to the end of the day. The risk premium for holding that should be less, because you are able to offload your risk in a much more structured and correlated manner across time. But no one can really tell you, like, okay, the weather for this period is going to do X, and hence I can hedge that. I mean, okay, there are weather contracts specifically, but you get my drift. The easier it is to access that type of risk, the less the risk premium, hence you have less return. So I will hopefully get a comment.
Well, I can add to on the equity side. I mean, you say the overnight risk premium has maybe gone. I think it's still there, but it's less significant than it used to be before. But there are still other sort of risk premium, if you want to call them, in the equity markets. For example, the best day to be long equities is from Monday to Tuesday, and that's probably because the worst day is going to be from Friday to Monday, because then obviously a bunch of people do close out positions by the end of the week, and you have a long weekend when you cannot trade, and things can happen. And that's particularly the case when volatility is at a high level. Then you just don't want to be long equities over the weekend. I mean, that's just as an add-on to what you already said.
Yes, Tim, I completely agree with that. There is this degradation, and I find the academic part of it where we can link these flows or some logical reason to it quite appealing. I do believe that these things will like also have their own seasonality, and one of the things that we can kind of think about is what's causing that, and if there was some time where Europe couldn't trade, if we kind of explode the situation we have in the global, arena right now, that premium would explode because you wouldn't be able to offload that risk as easily. So I do think that potentially, I've never tried this, but potentially, the seasonality of factors could be a thing. I I'm not an equity guy, but because it's such a well-known thing, and because you understand where these flows are coming from, it could be decomposed.
And another one to mention is the month-end rebalancing, where obviously with the passive investments becoming more and more significant in terms of market share, you get all these funds that have to rebalance, and that usually means you don't want to be, well, you want to be long bonds at the last day of the month, and usually equities as well.
That really hits on another point that I've been really focusing on in all markets, in fact, but the this idea of massive passive, and the I've done some research of its effect in commodities, commodity futures versus the ETF and their flows, and how much of that is really affecting the underlying say asset, and it is starting to distort like what you would consider classic seasonality. Say if you look in like the 80s versus now, because you have these month end effects or any of these type of rebalancing where they get reindexed. So absolutely, these are huge players who are getting bigger. And the fact is, I was always taught that you want to trade against someone who has to do something. And the fact is that they have to do something, and their PPM, the rules for which they have to act upon, are publicly known. I have never specifically targeted anybody like that, but I'm sure that they are part of potentially a new type of seasonality that will occur and get larger as more of these funds rebalance at some set schedule. Okay. I'm not sure my Twitter voting for topics is that helpful.
Hey guys, to break the silence and get into the discussion, it's just the way I see the topic, seasonality and timing, and I trade U.S. equities. Um, I don't think I pay any attention to seasonality. When I think about it, first thing that comes to my mind is like the monthly seasonality. Let's say usually the start of the year should be good for equities. This year we've seen otherwise. But when it comes to timing, the other part of this topic or headline today, then I see I see it more about market filters. Let's say, for an example, the easy and most used the 200 days simple moving average. Like I instead of seasonality, I pay more attention to using different timing filters for different strategies. And when I take this the start of this year as an example, then the seasonality, um, like the general assumption of seasonality, hasn't played out well in U.S. equities, but like when using a timing filter, let's say the 200-day moving average, then this has given like some signals the market's been in a short-term downtrend from start of the year and struggling to hold the moving average. So this is how I see it. Your quantitative work is obviously more sophisticated, and but yeah, I don't pay much more attention to it than just like to be at the right side of the market.
Thank you for that, Marcus. No, I think that is a kind of application of this because, okay, we're using all these high-tech tools, and I tried to mention that at the beginning. Some of the ways that we can do this is extremely simple. Most of the time, when you do any of these fancy decompositions, you're pulling out, maybe two or three, say, time series that this is made out of, and one of them is always the long-term trend. The final one should be some white noise, and when you pull that out, a 200-day moving average can be correlated to that, and when that long-term is turning down, you have now turned it into a very simple timing signal, because if that long-term trend does play out, you will have captured it. And so I think that that's where maybe the complexity gets in the way of the goodness, just because that effect is there and can be decomposed complicatedly, and you can take advantage of it in a complex manner. You can probably get 80% of the juice, so to say, from something extremely simple like that. And I'll take it a step further and do something and say, if you could find that the long-term trend has some period, you would be able to say, okay, instead of like 200, I want 150, or maybe I even want 500. It will give you a number to help you do that. But again, we know in our long-term trends, the difference between a 200 and a 300 or whatever is like relatively minimal when you catch these large things. So you're already in the ballpark, and then can you use it to fine tune a simple tool like that and give yourself some additional advantage?
Another application of seasonality, which is the one I mostly use, is to look at contract cycles. So and Derek, that touches on it's very powerful, for example, for commodities and anything that is material, i.e. made of stuff, non-financial. It's looking at what happens, generally speaking, in a certain commodity, and making sure that should liquidity be there, you sort of run your futures rolling cycle alongside with the main underlying cycle. And so that's how I play seasonality, rather than try and understand the intricacies and the specifics of certain products and how they are trading in the market. Because I think the professionals, for example, let's look at the agris. I mean, the Cargills and the big food companies will always know more about seasonality in real terms, but you can always understand the implication of winter versus season versus summer crops and stuff like that, and so use that to sort of set your futures rolling cycle, which is how I trade seasonality, rather than trying to find alpha from seasonality.
Actually, I think bringing up the physical commodities, especially like you mentioned, those that are physically delivered, and the effect of those dominant agents in that arena. They're not the ETFs yet. They're definitely like the Trifiguras, the Cargills. They also have this underlying seasonality, and yes, they may know more. What they will know is the delivery cycle of certain cargoes, where they are, and their quality. But I think you get onto 2 points there. One, the absolute cycle of winter and summer are so far a must. But also potentially, I mean, if you could understand what they were doing, if there are certain cargoes, then potentially you would be able to also take advantage of that. And I I know that in these large companies, their desks are specifically structuring that. And what they're doing is getting free optionality from the delivery and kind of like financially engineering how these things work. And they can extract free options um, from their own flows because they know they're going to affect the market. They know what that effect is going to be. And because they know it better than other people who are going to affect the market, then they have some kind of that edge. I mean, it's not, if it was probably equities, it'd be called insider trading, but because you know that this is going to have some effect. So absolutely, I don't think necessarily we can take advantage of it, but there are large, very, very large businesses that are taking advantage of this idea. And like you said, just doing the summer versus the winter is a very simple application, and you are probably being able to extract a lot of that type of information. I guess we can talk about timing a bit because I think that came up with Marcus, and I find timing to be the execution part of the seasonality, and that's why I put them together. So the seasonality is determining what is the cycle. The timing is trying to take advantage of it in such a way that is beneficial to you because it doesn't necessarily mean put on a position. I mean, either you could know more about it or you can reduce risk or something. And when you do something like this, and I think I gave the example already of this simple moving average example, can also help in other areas. So like the open close volume in equities is good for execution if you're smaller than the biggest players, or not only in the agricultural space or any of these physical ones, summer versus winter, but actually like the rolling cycle. If you roll between specific commodities futures contracts, um, there's the people who are left to roll, and you can begin your roll at some certain time if you're also holding a similar position. There is more optimal rolling times based on the flows there that you can perhaps harvest some additional ticks. Yes, it's going to be in the range of ticks, but over a cumulative amount of time. And if you're rolling this thing, say you've got a 20-year career, you could have in fact put a lot of money in the bank or saved yourself a lot of money on execution shortfall. So this idea can be transferred in many ways, and the examples I've given, the implementation is quite easy. And for this specific example I'm giving, you can just go to the CME website and look at the pace of roll, and you can look at the spread at any of these different points, and you can actually just use free data to figure out, like, do I want to roll today, tomorrow, next week? When is the bulk going to be moved? When is it going to become less liquid for me? Can I get ahead of this roll because I know I'm going to be holding this position for until the next potential roll? I can get ahead of it, and then I know people are going to be pushing this spread in a certain direction because there's more people loaded on one side than the other side. Again, it's a very simple idea that can be expanded to multiple aspects, and that idea of timing when you want to do something to take advantage of the cycle. People always say buy low, sell high. If there's some kind of signal for, say, agricultural that you would be able to take advantage of, one season against another season, then you would be able to do that. Or in fact, the reverse. If you were, say, short this thing and you were trying to roll into another position, if you knew that the spread was to your advantage, and sometimes, maybe you can even squeeze out, negative spreads in some of these situations. That means you get a credit for rolling.
This talking about timing, it reminds me this quote I recently saw that investors like to say that timing the market beat timing the market. And I guess obviously we as traders maybe disagree with it and believe that we can time the market. But on the other hand, I don't like totally disagree, because I think for like a very long-term trend following, this mindset may apply, that you want to be in the markets invested as long as possible, as long as the trend is on for your indicators or signals. So it's kind of a twofold, or what do you think?
I 100% believe you can time the market. My career is based on the fact that you can, or at least you can harvest something from it, and that thing is unstable, as in it's like a not constant thing. So even if you are harvesting a risk premia, or as in like some effect that keeps repeating, the magnitude of that effect is changing. So you don't necessarily want to be harvesting it all the time. I can see where they come from, and that's a very classic quote. The idea that you can't, or there's no skill, I think really gets its birth into the efficient markets hypothesis. Um, I don't think we believe in that, but I could be proven wrong. Maybe I'm just a survivor of survivorship bias. I mean, that's completely possible. Let's just hope I survive until I retire. um, how how to how to quantify that though? I mean, I think that that's what all we are doing. Like you said, I do think the trend follower is taking advantage of these things. We know that carry is embedded in any of these commodities futures price. That carry does have a seasonal component to it. So even by holding any front month contract, it is going to have some of this aspect in it. So um, if you are able to measure that and say, okay, get plus or minus this, then potentially something becomes much or less juicier. Um, only when I blow myself up. If I'm not wishing this on myself, I don't want to jinx myself, but like there is a potential that I don't become a survivor in the future, right? And will I blame it on timing or that it's impossible? Probably not. I'm pretty sure it's going to be I made a mistake.
Maybe going a little bit away from the topic, but on timing and cycles, I mean, ultimately, the signals that we get come from the underlying data that we look at. And then the question is, what is the underlying data? And I get the impression from having listened to this clubhouse and Jerry's clubhouse that most people look at daily data in some shape or form as their input data. But I mean, the question is that the best way to look at the data? I mean, why would sort of the daily data where for 10 days nothing happens and then you get one big day, why should they all be weighted in the same way? So why is the time axis, or is a time axis better than maybe an event axis where you sort of move your underlying data based on what's actually happening regardless of when it happens? And obviously there's different ways of doing that by sort of building your own data. I don't know, there's Renko charts and brick charts and grid trading and all these sort of things. Just wondering whether any of you have got any experience with this.
It is something I'm pushing towards, but I haven't gotten there 100% yet. But in my exploratory analysis, I think that you're right. The time-based access was just the simplest thing, and that's because we as humans live in the daily cycle, but that's not necessarily what the cycles of these underlying things are. Um, in fact, if you, like you said, like a Renko chart or something like that, even if you do like a simple volume bar, I have 10,000 contracts per bar instead of 1 hour or 1 day or whatever is the equivalent. You could find out how many on average contracts traded in a day, and then you could figure out, okay, like what's the average day, and then I make one bar equivalent to that. They will be very close, but you'll start to get, like you said, different outcomes for your distribution. It it sometimes, at least based on my analysis, will be much more normal. you will get better, like more log normal return characteristics when you start to do like first differencing and things like that. And I think it will dramatically alter any of this time series analysis we're talking about, and this timing, because the probability of over X amount of contracts, you have one big order, one big move is going to be the same, but on any given day it might not be. And because you're changing the X axis, it really does change things. But again, like I'm probably not the most experienced at this, but it's definitely something that has been quite interesting to me. Ticks as well, like how many ticks are occurring, uh, how much dollars have been traded. These are the areas that I'm really looking into and building an infrastructure to try to understand that better.
This is probably a topic in its own merit, and I think I brought it up last week as well. I think for me, when it comes to time and how to look at events in markets, the most interesting thing that I'd like to get a grasp on and understand is, for lack of better words, energy cycles. So if we want to translate it back to time, how long it takes for a market to swing from a situation of high to low, and then of course now we're talking about seasonality and other cycles, but any kind of cycle you want to investigate, I think should be investigated in the frequency domain and not in the time domain, which obviously raises other problems, because Fourier transforms work up to a certain extent, so you have to use slightly different techniques, and there's not a lot of material out there that points in a unique direction that tells you, how to handle all these things. But it's really interesting if you can find a way of monitoring these cycles in as frequencies, and and so look at amplitudes and all of that, then you can get a lot out of it. And then if you translate that back into time, then the time dimension becomes elastic. So it might take, for one of these cycles, it might take a week, or it might take a month, or it might take a day, and that's where you have your sort of chronological time dilation and compression. But that's how I look at it, even if I don't have a set of actual, there's no silver bullet, and there's no kind of unique way or absolute way to measure this cycle. So it's a bit complicated, but it works once you want to to move into that dimension. Much in the same way as advocates of constant volume bars will tell you that that's how you should look at the market. And other constant price bars advocates will argue that case and all of that. So I think there's a bit of debate going on, but it's certainly the right way of moving away from chronological time into some other dimensional aspect of time.
Very interesting. Okay, I have dabbled in something similar, but it still has a time dimension, and that's wavelets, because of what you said, uh, of the issues with Fourier transform, right? So like when you can decompose it into multiple wavelets, then you basically do the same thing as like when I was talking about the whole winter, right? You can get like the short term, medium term, long term wavelets. I was at my maximum complexity back then, trying to feed this into an ML model on crude oil. Oh my God, why was I doing this thing on super short-term time frames, holding period less than 5 minutes? And yes, but it's damn hard, and it's extremely brittle. Like I maybe, I don't know, this was years ago, 6+ years ago, so like I'm not sure, but my experience with being able to get something stable, because that's part of it, right? Yes, we have tons of data when you're that short of a time frame, but how the thing is changing in your optimization cycles and things like that, I'm not sure. And then if you're trying to train something even on daily data of these wavelets, uh, I'm not sure you would have enough. So you would need to be able to generate more data, but we know how to do that, with Bootstrap and all. But I'm not sure how that would affect the wavelet, because you could be filtering to your Monte Carlo or bootstrapping technique rather than fitting to the actual underlying. So once you start to get into derivatives of things, trying to model that with synthetic data becomes way more difficult. Does anyone else have experience with this type of stuff? I would like to know. Okay, well, I won't recommend it then to anybody. Okay, or if you do find some success, please let me know so I could go back to my old work.
Yeah, I mean, like, I think you've gone really, really far down, that rabbit hole. I have done something a little bit more simple, and so, for example, you can think about if just move from the time domain to the frequency domain, trying to recover a sine wave of some kind, and that will give you an idea of what the markets are doing. But sine waves themselves are going to have different amplitudes. So you can. It goes back to our age-old question: can you identify trends versus consolidation period? But looking at this, at the way these sine waves, which of course are irregular because the market doesn't have a fixed periodicity, but these sine waves occur. So looking at those is a good way. As a timing indicator, you may say, okay, I have a sine wave of a specific market. Now I'd like to advance it by, I don't know, a quarter of a cycle or half a cycle, and then see when these things cross. And so all of a sudden you have an indicator which is like a moving average, but in different domains. So that's more the stuff that I'm interested in. I agree with you. The wavelets are incredibly complicated. You have aliasing and all sorts of problems. So as you said, you sort of create your own signal, and you don't even know if you're following your signal or the market signal. So it's a bit complicated and a bit hard in that sense. But what I was this sine wave analysis is a bit more simple, and I think it certainly yielded good results for me.
That's interesting. So, can you explain it a bit more? So you've translated. Okay, we were talking about energy, and you've translated the market moves into frequency domain, and then in the frequency domain, you're able to extract sine waves. But I don't know what. Maybe I need a better clarification of how you're translating it into
Yeah.
frequency.
Well, you can think about a Fourier transform or any kind of that there's various ways of doing. But let's say Fourier transform until you recover. Instead of seeing a time series with drifts and stuff like that, you see oscillatory movement. But those oscillations, unlike let's say electricity, that have a fixed period and they have a very repetitive patterns, those things have different amplitudes. Those sine waves have different amplitudes. So when the sine wave sort of stretches out in time, you can say, okay, I'm having a trend. And then obviously price will determine a drift, whether it's an uptrend or downtrend. But you're pretty sure that you're in a trend. Whereas when the oscillation is up, down again, you can think, okay, well, the market is consolidating around some sort of areas. And this correspondence, I couldn't say it's a one-to-one mapping, but it's pretty close to one. So you filter instantaneously, you can see when markets are trending and when they're not. And then you can decide what to do with it. The concept I was saying about advancing the main sine wave by a certain degree, so a quarter of a cycle or something like that, gives you some sort of timing tool. As you said, you believe that we can time the markets, and I, to a certain extent, concur, well, actually, to a high extent, agree with you. So, think about this advanced, or this synthetic wave advanced by a quarter of a cycle. That is obviously a fictional signal, but when this fictional signal crosses from either from above or below your main market wave, then you can say, okay, well, this could be a turning point. And then you can say, and I stress the point could, and then you can say, okay, is the market sort of turning here? If it is, I think that's a pretty good indication that energy is swinging from a high back to a low, or the other way around. So that's basically, hopefully this explains how to do it, but that's basically what I was doing, and what I still am doing with some of those indicators.
So as I understand it, it's not a mixture of sine waves, which is what I thought it was at the beginning. It's one sine wave that's the frequency itself is changing, and that's fitting to something, and then you can push it forward, like you said, a quarter of a cycle.
Yeah,
And
that's
then,
right. You can also experiment with taking because in transforming from price to frequency, you can have different ways of doing it. So you can try and see, okay, I want to see a long-term cycle, I want to see a slightly shorter-term cycle. But yes, you're absolutely right. These sine waves should not be commingled. So you have to have an idea of what an average cycle could.
I think the idea of energy is quite interesting. I mean, that goes into the idea that we were talking about of these information bars. Not time domain. What does that do to the time series analysis? And what could potentially, like, delta long minus delta short be energy? Like, that is the residual energy or something like that? Like, I don't know. I'm just digging into your rabbit hole too.
No, well, it's actually, think about this. It's actually quite simple. So when you move from time to frequency domain, you see, is energy raising? Is energy falling? Like, I don't. I mean, yes, you could really focus on the y-axis, so how much energy you've got. But if you focus on, what is this sine wave doing? Is it raising? Is it falling? Is it stretching in time, or is it happening very quickly? You have there some pretty good indications of the dynamic of the underlying price movement. So yes, you're touching on the questions that are unanswered, and I was trying to simplify the approach just to give everybody an idea of how to quickly move from one domain to the other and start looking at things. But yes, you're touching on very complicated points, Derek, which I don't have answers for. But even the simpler approach yields some good results. Basically, that's my comment for all of us, if it makes any sense. If I haven't managed to confuse you, too much.
No, I'm understanding it is actually like the kinetic energy in the wave due to frequency and amplitude, and then you
That's
measure
right.
that.
That's right.
Yeah. Well, I see Arthur here. Hopefully, he can chime in. And thank you for the reference to the stationary bootstrap. I was reading that today. It's very interesting. The section on the extensions and the multivariate was quite cool. So thanks for that.
Hi, Derek, and everyone. Thank you for your feedback. And yes, so related for today topics is actually I I don't have many insight to share. I think I only attempted once in commodity term structure modeling to apply some seasonality, and well, results were not meaningful, right? Statistically meaningful. So today I'm more in listening mode. I think with your comment on Bootstrap, it's really useful techniques, especially for data. Yes, this type of data where not only the price data, but also fundamental data and data where you have limited, say, sample size. You have also correlations that autocorrelations that you would like to preserve, and therefore I think it's useful techniques that particularly I like to apply in crypto markets.
I will bring it back to crypto. We did discuss the seasonality in agriculture and physically delivered commodities, but I do think that there's a great example of seasonality coming from an exogenous factor, which is the 4-year cycle of the happening in crypto. And I think earlier, we were talking about how these things can decay. I gave the example of equities overnight premium. As we became more global market, people were able to offload risk in other highly correlated markets, and Globex became 23 hours a day. So that kind of decreased, although it's not gone away. Have you seen anything of this type of decay? Because people are talking about like super cycle or the extension of a cycle in crypto. In your research at all, Artur, or you haven't looked at it?
Well, I haven't looked at it yet. I think one feature of crypto is not, say, super liquid for this type of intraday strategies. I believe. Or with regard to equity markets, I think yes. Also, if we talk of this kind of intraday pattern, I think I attempted so long story short, I think it's only work for S&P 500 or for limited US equities. For some, it doesn't work for say European equities, right? And therefore, it always limits. So it could be more idiosyncratic patterns, right? That it's not a systematic, say, risk premium or systematic strategy that can be applied across different instruments. That is was my conclusion, right? But I'm interested to see other ones. If someone ever attempted to do this kind of intraday mean reversion strategies, if you call them also seasonality, but if someone had experience.
I think that no, I have not. I have not been able to see it in other areas. I do think that is at least the last time I checked, mostly a U.S. phenomenon. And the idea that it's idiosyncratic, I will bring it back to crypto again, is because we are only looking for cycles in Bitcoin specifically, because it has the miner cycle, but other cryptos don't necessarily have that same cycle. So um, I feel that that could now be, with such a large universe and it's much more liquid, and in the crypto, say top 10 or top 100, that's just an idiosyncratic thing. And as its general market cap is decreasing, then maybe it becomes less influential. I'm not sure. But another thing that we had discussed earlier was the movement of large passive players. And I had done some research that these ETFs have affected the commodities markets, changing their distribution in a meaningful way. And I'm wondering if that will start to happen in crypto as well, or these type of funds coming in, or like a longer buy and hold, or say long-term active managers coming in that have gotten a lot of AUM in the recent year, are also starting to change that distribution, such that the seasonality that is baked into Bitcoin gets overwhelmed or dominated by these other flows, and potentially that will create a different pattern, say just based on increasing AUM or increasing flows, and it becomes more a financial product than a miner-based product.
Yeah, that would be interesting to research. I think right now I haven't looked at it yet. I think probably would be more like a term structure of futures, right? Would be probably more affected by this criteria. Yes.
I'm going to pick on Andy. Andy, in your experience trading equities, have you seen or used any of these techniques, either seasonality or timing?
I have not used. Well, I mean, listen. I'm the kind of guy who could talk about anything. I have not particularly used seasonality aside from some graduate school work. But I was curious. Whenever Marcus was talking about like I'm not sure it's a good example, but like Hasbro, somebody who sells a lot of toys for Christmas, kind of, yeah, like it's very obvious that that's all going to be priced in. Somebody who sells more at the end of the year. Just throwing that out there in case that's interesting, that somebody wants to talk about. But no, I have not used seasonality. It hasn't really worked with any of my models. And then timing, I'll be honest, I got a little bit distracted with my work, so I didn't necessarily hear what that was.
No, but I think that that's an interesting example to pick up, because again, a lot of these large seasonality plays comes from well, unless it's a financial instrument, when we see it's more idiosyncratic, like say S&P 500 equities for this overnight premium. A lot of these ones that come out come from external source, and so potentially you have a sector of toy makers uh, that will have holiday seasonality, and then how to price that, because most people are going to try to buy their kids a toy for Christmas, um, will play out. And then could you do relative value there, or could you actually just price the optionality on how much is priced in of the expected sales? Can you build something like that? I do think that that's the case, and that's the same thing with, we were talking about metals earlier, and agriculture, when these large trading houses, like I think we already mentioned, try to figure out Cargill, Anglo American, these guys, they're trading the cargoes themselves. And it's because they know when is the delivery and the pricing and the quality and where they are located before they hit the market potentially, and they create this type of optionality. They are able to extract this free option out of having that. So potentially there is an option embedded in these types of things, and what's the timing. The question is, how do you price it? So maybe there is something there, Andy.
I just can't imagine. Yeah, and then also it's the same thing with natural gas. Like of course, people in the winter. I guess winter's distributed around the globe, but I mean in the U.S., yeah, there has to be seasonality. But I mean, I just don't. I'd be shocked, to find that there's really a repeatable trade. But I've been shocked before.
No, I mean, I think you're probably right. I would default to that there is not any statistically significant or meaningful thing, and that I'm just blowing a lot of hot air. Most of my research goes that way. It doesn't come out to anything meaningful, but the framework that we're all able to pull out examples from, everyone who's standing up here kind of understands this underlying dynamic. And I think breaking that up into what would be idiosyncratic or just related to that specific instrument, and those that come from um, potentially external sources but affect a sector or an entire set of markets, is really important, because when you're doing this type of thing, we need to think of our sample size, right? That's like the number one rule. And if you are able to find something that's repeatable against, at first a single thing, and then it's exploitable against a whole sector of things, and then you actually can find that it exists potentially in other ones, but maybe isn't as good, it's good enough. And so that's how we can transform from doing the time series analysis decomposition into a framework whereby we can actually try some timing to capture that, either to gross or degross our risk, or to try to just capture it explicitly, or potentially it becomes well known enough that it does become one of these risk premium, like the overnight thing. And the question is, if that logic was true, which I had given, the U.S. is able to de-risk, then why doesn't it exist? Like I don't know how important it is to kind of like backwards engineer why something does exist, but we don't frequently ask why something doesn't exist. And right now, I don't have that good answer. So, I mean, I would guess that that's much more fragile. But if it's an agricultural commodity, we know the old crop versus new crop that's going to exist. We know exactly why that is, and it becomes much more robust. So, I mean, I think all of the good strategy development skills and kind of quantitative thinking, systematic thinking, probabilistic testing. Um, really can transform some of these abstract ideas that we've just been kind of throwing around and seeing if there is something good there. I mean, I would guess not. There's a lot of smart people working on it. I never imagined that I'm the first one to discover anything. Well, I guess I will wrap this session up. It didn't hit off as good as I'd hoped, although we did dig into some topics. And thank you to everyone up here, Bruno, Marcus, Tim, Andy, and Arthur. All of your comments were really good, and we were all able to contribute. So thank you for coming in.
Thank you, Derek. I think it's a hard topic because it's something that we don't like. It's difficult to say monetize this. Even they exist, it's in my opinion, you cannot build. It can be part of your say signal or strategy, but it's something that my feeling is that it's not like say it's not transparent, right? Maybe some term structure trades you can exploit it, but in volatility is probably more the term structure effects, right? In say in options, it's more like around say releases of earnings, or like for single stock equities. For macro, it's maybe economic announcements. In volatility, it's probably more exploitable, this type of seasonality modeling. But as I say, in Delta One, I doubt it's. I can't. I'm sorry, guys. So probably if there was little, say, contribution from people, is probably just more constatation that it's a hard topic than interest. But thank you. Yeah.
Thank you for those last words, Arthur. We do try to go after the hard topics here, and I guess that's necessary, having a smaller audience. But you're absolutely right. Part of that inability to execute it in a Delta One just makes the audience so much less. But as always, I appreciate you guys sending me your topics or topics that come up. I'm always happy to have the next Clubhouse do that. So if you have any new ideas or white papers to discuss, please DM me on Twitter, and then I will put it in the poll for the next week. Everyone have a good night.
Cheers, guys. Ciao.
Good night, guys.
Thank you.
Thanks. Bye.
Ciao.
All right. Bye.